Hello, everyone. Adam Bergman here, tax attorney and founder of IRA Financial. Now, today's video, still time to maximize your 2022 IRA contributions/deductions. So I wanted to spend some time doing a video on this topic because everyone is inching to get into tax preparation mindset. Right? Getting calls from accountants, emails from your accountant, hey, send in your information, your 1099s. Everyone's starting to think about filing their return, right? If your 1040 individual tax returns due April 15th, if you have a partnership, S Corp, March 15th, around the corner. C Corp, April 15th. So single member LLC, April 15th. So time flies, right? We're ready February 15th here, a month to 2 months away from tax return deadlines. Still time to maximize 2022 contributions. So today's video, I'm going to start IRAs, and then I'm actually move to the solo 401k world for a bit and let everyone know there's still time to take advantage of an amazing deduction capability that you'll make your tax accountant very happy. So let's start with IRAs. Traditional IRA, Roth IRA for 2022, 6,000 or 7,000 if you're over 50. The numbers have gone up for 23, 6,500 or 7,500 if you're over 50. But talking 2022, can you still do it? Yeah, you have until April 15th to do IRA contributions for 2022. Now, of course, you need earned income. You need to have some compensation for services, W-2, 1099. Can't just be disabled or have Social Security or have passive income like capital gains, interest, dividends, royalties, rental income. You need to have active business income or compensation for services. So that's the IRA world. Now, what happens if you have access to a 401k at work? Can you still make IRA contributions? And the answer is yes. Okay, but there are income limitations in terms of how much you can actually contribute into an IRA if you have access to a plan at work. These rules are kind of confusing. I don't know why they have them, other than just not allowing people to put more money into a 401k on a tax deductible manner. It's frustrating, right? We're talking 6,500 or 6,000, 7,000 bucks. Like, are we really going there taking deductions? Yeah, the answer is yeah. So if you have access to an employer plan, not your spouse, but you can still make an IRA contribution. But if you are single and you make more than 78K, you can't. If you're married, it's your own 401k, 129,000 bucks. And if you're married and your spouse has access to a 401k, it's 214,000. So meaning if you are single and you make more than 78K and you have access to a 401k, even if you don't actually make a contribution to the plan, you cannot do a pre-tax IRA for 22. You can do a Roth potentially, and we'll get there in a minute, but you can't do a pre-tax. You can do an after-tax IRA and convert it to Roth, but you can't do a pre-tax. If you're married and it's your 401k that you have access to through work, even if you don't make a contribution, you make more than $129,000, you cannot get a deduction for your IRA contribution. You could do a Roth, backdoor Roth, but not pre-tax. And if it's your wife or spouse, I should say, who has access to a 401k at work, even if he or she does not contribute, if they make more than 214, then you cannot do a pre-tax IRA. You can do Roth after tax, but not pre-tax. Arbitrary, right? But the IRS does not like deductions, right? Deductions reduce taxable income, means less tax revenue for Treasury, so they try to limit deductions. So for a traditional IRA, if you have access to a 401k at work, based on the numbers I just mentioned, you may or may not be able to do a pre-tax IRA. What happens if you have a SEP IRA or a simple IRA? Can you still do a pre-tax IRA? The answer is yeah. They are not interconnected. A SEP IRA is a pure profit sharing plan. You can still do a SEP IRA up until April 15th, or when your company files its return. So it could be March 15th, extension to September 15th, April 15th, extension to October 15th. You can still set up a SEP IRA for 22, even though we are sitting in 23 now. And even if you contribute and max out to a SEP or don't max out, you can still do a pre-tax IRA or even a Roth IRA. Why? SEP IRA is a profit sharing plan. It comes from the business. It's a percentage of your net Schedule C, 20% of your sole proprietor net Schedule C, single member LLCs, or 25% of your W-2, up to a cap of $61K for 2022. That number has gone up to $66,000 for 2023. So if you made $100K and you have an S corp W-2, $100K salary, you can do $25,000. So you're under the $61K. And then you can also do a pre-tax IRA or a Roth IRA as well. Simple IRA, unfortunately, the simple IRA deadline is passed. You generally have 2 weeks after January to do it. So we're sitting in February. So for 2022, you cannot do any more simple IRA contributions, but you would be able to do SEPs and traditional or Roth, and ultimately a 401k, which I'll talk about in a few minutes. Now let's talk about a Roth IRA. Okay, a Roth IRA is essentially an after-tax IRA. You don't get a tax deduction for doing a Roth IRA, but so long as you're over the age of 59 and a half, the Roth has been open at least 5 years, it's all tax-free. So who can do a Roth IRA contribution? Well, there are income limitations. So if you make more in 2022 of $214K, married, filed jointly, or $144,000 single, you can't do a Roth. But, it's a big but. Something called a backdoor Roth IRA. Since 2010, there's no more income limitations for doing conversions. So the workaround is you can easily just do an after-tax IRA. So let's say you make $1 million a year or more than $214,000. You can just do an after-tax IRA contribution and immediately convert it to Roth. The IRA custodian will file a 1099-R showing a zero Roth conversion number. And then now you're able to move the after-tax to Roth. And now even though you made more than 214 or 144, the number is going up to 153 if you're single in 2023, 228 if you're married, filed jointly. But the backdoor Roth IRA will let you get into a Roth even if you make $100 million a year. One thing to keep in mind is if you have other pre-tax IRAs out there from previous years, there is a pro rata formula that will limit the amount that can be converted. So if you had a $5,000 IRA that's worth $5,000 today that you contributed in 2016, and now you want to do a $5,000 backdoor Roth IRA, only half of that amount will be tax-free, and the rest would be taxable based off this pro rata formula. So just something to keep in mind if you have other pre-tax IRAs. So if you have a SEP, have a simple, you can still do a Roth IRA or a backdoor Roth IRA of $6,000 or $7,000 if you're over 50. If you have access to a 401k at work, you can still do a Roth IRA or a backdoor Roth IRA if you make more than the 144 or the 214. Unlike the pre-tax IRA, income limitations, no income limitations apply other than that 144 or 214. There's no reduced limitation income numbers if you have access to a 401k at work, like a pre-tax IRA. Why? Because it's not pre-tax, right? Roth IRAs are after tax. So IRS, Treasury are not worried about tax deductions. So that's the IRA world. So in sum, there's still a lot of opportunity to get deductions. And if you're not looking for deductions and looking for Roth, still a lot of opportunities to take advantage of contributions for 2022. We're sitting in February here. If you're watching this, so long as you're watching this before April 15th, you can still do traditional IRA or Roth IRA. If you make too much to do a pre-tax IRA deduction because you or your spouse have access to a 401k at work, no worries. You can still do a Roth IRA. Okay. If you contribute to a SEP or a simple in 22, you can still do Roth IRA, backdoor Roth IRA, or even potentially traditional IRA contributions in 2023 for the 22 2022 taxable year. So it's the whole point of today's video, right? You still have time. Just because the calendar turned to 23, don't give up. There's still an amazing amount of tax planning opportunity in the IRA world. Now, let's move to the Solar 401k. Secure Act 1, which passed December 2019, and Secure Act 2.0, which was passed December 2022, adds a lot of strength to Solar 401ks. And what it does is now you can set up a Solar 401k in 23 for the 22 taxable year. Prior to December 2019, or I should say 2020, you had to set up your Solar K in the same year you wanted to make contributions. So you'd have to set up your plan in 18 to make contributions for 18. Now, you can set up a Solar K in 2023 and take advantage of make contributions for 2022. So what's Solar 401k? The most you can put away in a Solar K is $61K for 2022 or $67,500 if you're over 50. Like a SEP IRA, there's a profit sharing component, which allows you to do 20% of your net Schedule C or 25% of your W-2. But unlike a SEP IRA, Solar 401k also has an employee deferral component that lets you put away $20,500 or $27,000 if you're over 50 for 2022. Okay, those numbers have gone up in 2023. But for the moment, just focusing on 2022, if you set up your plan in 23 for the 2022 taxable year, the Secure Act 1.0 now lets you do that. Secure Act 2.0 says starting for the 23 taxable year, you can also make employee deferral contributions on top of profit sharing. Now, it's unclear whether the Secure Act 2.0 applies to the 22 year or simply applies for 23 going forward. It says in Secure Act 2.0 that it applies for the 23 taxable year. So generally the consensus is if you set up your plan in 23, you're only still allowed to do profit sharing contributions for 22 because we're talking about the 22 taxable year. But you can still do profit sharing contributions. So it kind of mirrors what a SEP is. But a Solar 401k will let you also do a loan feature, lets you borrow $50,000 or 50% of your account value, and you have a lot of other asset and creditor protections as well. So what do you need to set up a Solar K? Well, you need to have a business. It could be a side business. You don't have to be the next Google or the next OpenAI. You just need to have a side business. Be a sole proprietor, single member LLC, C Corp, S Corp, doesn't matter. Just need to have a business that generates some earned income, some business income. Whether you're selling Nike Dunks on eBay or you're selling photos or furniture or used Chanel bags on Etsy or the Real, wherever, doesn't matter. You just need to have a side business. Okay. And then whatever you earn in that side business, even if you're the CEO or CFO of a large corporation, you potentially can still make contributions to a 401k. So let's take a few examples. Let's say I have a huge job and the CEO of a company, and I max out my 401k at work. But I make $40,000 selling Nike Dunks on eBay. I can still set up a Solar 401k for my side business and do 20% of 40k, giving me another 8k. If I had an S Corp, I can do 25% of 40k, giving me 10k. And that's on top of the money I put into my 401k at work. Now, let's say I work for a business and I only put in 10k into the business 401k, and I have a side business selling Nike Dunks and make 40k. I can do the difference between 22.5 and 10k, which is 12,500, plus 20% of 40, giving me another 8 or another 20,500 in the aggregate, plus what I put into my work 401k. Let's say I have a work 401k and I put 0 in, but I have a side business and I sell Nike Dunks on eBay. I make 40k. I can do 20,500, right? Because I didn't put anything into my work 401k, plus 20% of 40, another 8. So out of that 40k, I can shelter about 28,000 or so of income. Pretty good stuff. So just because you have access to a 401k at work, even if you max out, if you have a side business that generates some decent revenue, even if you maxed your employee deferral limit of 20,500, 27,000 if it were 50 for 2022, 2022, you can still do the profit sharing of 20 or 25%. So every dollar adds up, right? If you do that for the next 5, 7, 10 years, all that money goes into your plan. Instead of paying Uncle Sam, you're putting that money away and sheltering it from tax. So it's a double win. You get the tax deduction, plus that money grows without tax, and you can invest it as you see fit. So putting it all together, 2023, do you still have opportunities to save in an IRA for 2022? Yeah, you can still do the traditional Roth IRA up to 2022. If you have access to a 401k at work, you or your spouse, there may be limitations on tax deductibility of pre-tax IRAs, but you can still do a backdoor Roth or even a Roth IRA if you made less than 144 or 214 if you are married, file jointly. Still can do a SEP up until your business files its return. You can still do a solo K for the 22 year, even if we're in 23, just like a SEP. Going forward, starting in 23, you're also going to be able to do employee deferrals and profit sharing. Right now, for the 2022 taxable year, it seems based off Secure Act 2.0 that all you're going to be able to do is just profit sharing for the 22 taxable year. But starting in 23, you would be able to set up a plan in 24 for the 23 year and also get the employee deferrals, which have gone up to $22,500 or $30,000 if you're over 50, plus the profit sharing, even if you set up your plan in 24 for the 23 taxable year. So there's a whole slew of exciting tax planning opportunities. If you're a client of IRA Financial, let us know. We'd love to help you, kind of put you in the right direction. Happy to discuss this with you or your tax advisor. You should talk to your CPA about this. Everyone should have a good CPA. I'm a big believer working with good accountants. They can save you a lot of money. Even if they have a pretty sizable fee, and generally accountants aren't expensive as lawyers. Generally, their fees aren't horrible. They're going to save you money. They'll help you tax plan, whether it's deductions, various ways to reduce taxable income. From an IRA perspective, we will happily jump in if you're a client of IRA Financial and give you tips. We'd like to know, do you have a side business? Maybe you can set up the solo K, put away another 20,000 plus or even more. At least you should be putting in Roth IRAs every year if you have free money. What about the traditional IRA? If you're looking for deductions, have a SEP, you can potentially do a traditional IRA. So there's a whole variety of ways that you can potentially save more, reduce your taxable income even further for the 2022 year, even if we are sitting in 23. So that's today's video. I hope you guys enjoyed it. I think it's important to keep focused on tax planning. A lot of people just kind of turn off 2022 once January rolls around, but don't, because in the IRA world and the 401k world, especially if you're self-employed, there are still enormous opportunities to save. And trust me, when you're writing that check to the IRS, gaining the opportunity to even reduce taxable income by $5,000-6,000 or more if you're self-employed, it helps. It helps. Trust me, I've been there. Hope you guys enjoyed the video. If you have questions, comments, leave them. I will do my best to get back to you ASAP. We have an amazing team of tax professionals standing by. So if you're a client of IRA Financial, and even if you're not, call us, chat us, email. We'd love to help you and hopefully educate you about some really important tax planning opportunities where you can generate important tax deductions or even just put away more in a Roth IRA simply by just understanding and navigating the rules. I always say this, and it's the last thing I'll say, I promise. I have obviously university degree, law degree, master's in taxation, worked at some of the largest law firms in the world for 9 years. And I can't tell you how long it took me to understand how the IRA and Roth IRA world works. I didn't learn for 1 minute. I didn't take one course in law school, in LLM program, even as a tax lawyer, how IRAs, Roth IRAs, and 401ks work. So I probably lost over the first 10 years of my professional life at least $50,000 to $60,000 in contributions I could have made to Roth, which I never knew I could. And how much would that be worth today? And how much would that be worth in 20 or 30 years? Probably high six figures. I had the money available. I could have put away an extra $4 or $5 grand in my Roth IRA. No one told me I was able to do it. I thought I maxed out my 401k. I was a lawyer. I'm doing well. I'm smart. No one told me I could do a Roth. So that's my job. I'm putting my tax lawyer cap on to hopefully educate all of you that, hey, there's opportunities out there, even if you're maxing out your 401k at work, or if you're not, or if you have a side business or you're maxing out your SEP, you still could potentially put away more in a traditional IRA, a Roth IRA, and if you're self-employed, potentially even adopting a solo K to put away a lot more money. And if you do that for the next 5, 10, 15 years, you're talking high six figures, if not seven figures, when you reach your 60s or 70s of just free money that's going to be lying around that you pay tax on. So what an IRA or 401k does is it reduces your taxable income and shelters that growth from tax. So you get a double benefit. And just unfortunately being aware of it. Most of us are just not focused on IRAs. We're dealing with jobs, we have stress, we have family, we got health issues, we got all the other stuff going on in our life. And no one's kind of knocked this on our head and be like, hey, just put away a little bit more. You still have time. 22 left, but 23 is here, and you can still put away money in an IRA or 401k. You have time. Just write that check, because I promise you, do it for the next couple of years. When you're retiring in your 60s, 70s, that money's going to add up quickly. And over that period of time, it could be significant. And all it takes is just a small check that could actually reduce your current taxable income and also help you down the road when you have a really, really large retirement asset pool that you just didn't even realize, could have grown that far, and that much, but it did. So hope you guys enjoyed today's video. Check me out again next week. So weekly video. Generally do it Wednesday, noon Eastern Standard Time, but subscribe, like the video, and leave a comment, leave a question. Get back to all of you, I promise. Otherwise, have an amazing rest of your day, and take care.